conversions and how to keep minimizing those required minimum distributions and how to look for keep maximizing that tax efficiency. Oh, thank you all for being here today. Just for you to know, important information. I'm not acting as your financial advisor in this presentation. Everything is for educational purpose only. Remember, it's not investment advice. It's not, if we talk about some returns, I'm not guaranteed any returns for the future. I'm not selling you any investment product or anything like that. And everything is just for educational purpose only. If I have to introduce myself, I'm a certified financial planner. I have been in the industry for the last 27 years. I have been named by the Investopedia and ETF between one of the top 100 financial advisors in the US. It's a great honor to be in that list. And also in this year, in 2025, I have been named by Go Bank and Rate between the 100 top money experts. By the way, I'm a fee-only advisor for you of you if you don't know what it is. A fee-only advisor is one that cannot receive any fees or commissions from third parties. Be really careful because in our industry, sometimes we make works a little bit complicated. I'm not a fee-based advisor. I mean, a fee-based advisor are the one that gets fees or commissions from third parties. So be really careful with that. Sometimes if you're looking for a fee-only advisor, yeah, you can expect the advice to be more unbiased because we don't receive any fees or commission from anyone else, just from our clients directly. So if we say it like that, today we are going to be talking about a really strange word in Japanese. It's called Kintsugi. I'm going to talk about that. Some Roth, what is the connection with that, and Roth conversions, why it makes sense, when it makes sense, and when it doesn't make sense to go for some Roth conversions. We are, of course, going to take RMDs into consideration, those required minimum distributions. We're going to talk about tax bracket optimization and something that we call the valley of tax optimization there. Something, so of course, we can also discuss when it does not make sense to go for a Roth conversion. And if you have any questions, please let us know. You can write it in the chat. My team will allow me to help you with those questions. We can discuss this in the middle of the presentation, or also I can discuss it after that. Yeah, so let's go and get started. Kintsugi, why I brought that strange Japanese word for a webinar about Roth conversion. Most of the time, you will be seeing, like, I don't know, a couple next to the sea, at the beach, or maybe in a beautiful jet, thinking about their retirement, but not something like this. What is Kintsugi? It's when you repair an object and make it more beautiful. In Japan, the way this is made is like a pottery. They break that pottery, or it's broken already, and they stick all the pieces but with gold, so that make that new piece that will be more valuable than the original one. So why I'm bringing this one here? Because in a way, Roth conversions are like that. In a way, you are willingly go and pay taxes for something that nobody was asking you for. So let's keep discussing about this particular concept, from Japan and how it gets related. So what is a Roth conversion? For those of my clients or people that are meeting with us today, a Roth conversion is like, as you know, you have been saving all this money in a 401k or in a traditional IRA or many other different kind of accounts that are tax deferred. You have been able to give those contributions to this account, and for those contributions, you have been able to reduce your taxes for each contribution that you have been making for all these years. After that, your money has been growing and growing in a way, if you invested, of course, in a way that is tax deferred. Uncle Sam has not been charging you taxes on that money. So that money has been able to keep compounding and growing and growing. But now, Uncle Sam is going to tell you in the future, maybe, hey, that account was tax deferred, was not a tax-free account. So now it's time for you to start paying those taxes. What you can do? Well, one of the strategies for you to keep optimizing that, instead of you having paying more taxes, could be a Roth conversion. What does a Roth conversion means? Well, you are taking money from or assets from that 401k or traditional IRA, and you're transferring those assets to a Roth IRA. The Roth IRA, as you know, is a tax-free account in an account where you already pay taxes on. So when you're transferring those assets, that money is coming as income to you. And because of that income, you had to pay taxes on that. The beauty about this particular situation is that in this particular case, you are the one that is deciding how much money you would like to withdraw, how much money or asset you would like to take from that. It's not like where you're having your wage or your bonus. Someone else was deciding how much money you were making. In this case, you will be able, like your own boss, you will be able to move that income as you wish. But at the same time, you have to take into consideration different aspects that we are going to be discussing today. So that's what I said, that this concept for me, it relates to that, what is called Kintsugi, because you're kind of breaking that 401k before it was ready. Because the IRS was not telling you to withdraw that money to be paying those taxes today. And sometimes you can think, why somebody would like to do something like that? Why somebody would like to pay taxes today instead of paying those taxes in the future? So let's keep discussing about that. In a way, the thing is, like, the IRS will always want his money. Remember, the IRS has been your retirement partner in this account for many, many years. And now he says, I need my money. And that's when required minimum distributions kick in. What is this? The IRS is telling you that you must withdraw some money from your 401k or your traditional IRA. When that usually happens, we're going to discuss about that. What kind of accounts are the ones that we discuss in this situation? 401ks, IRAs, SEP IRAs, 457, simple IRAs, 403bs. All those accounts are tax-deferred accounts. And now's the time for you to start withdrawing money from that account. And the Uncle Sam wants his money and he's going to get his taxes. What kind of accounts does not have some require minimum distributions? Well, the Roth IRAs and, of course, the Roth 401ks, because you already paid taxes on that. You already, with your contributions were after tax, and you already have paid taxes on that. And that money keep compounding, growing there. So the thing here is, like, when the IRS is asking you to withdraw that money, sometimes it's not, you don't have the chance now, you don't have the flexibility now to decide how much money you would like to be withdrawing from that account. If we take a look about that, when you should start taking those RMD, it will depend. Yeah, the law has been changing for someone that was born before 1949. Maybe now he's already taking RMDs because the first age, is 70.5. Maybe that's the age that most of the people has in their mind. After 2019, the law changed with the Secure Act 1.0, and those born between 1949 and 1950, in that almost year and a half, if you're 72 years old, now you have to start your required minimum distributions. And if you're, the new law means, like in the Secure Act 2.0, it changed that a little bit, because if you're born between 1951 and 1959, so we still have some room there for people that are still there, your RMD will be 73 years old. And for those that were born after 1959, you can say that your required minimum distribution age will be after 75 years old. So as you can see, the number could be different, but the tax effect could be the same in a way, because you're getting all this money that is coming to you. And maybe because all that money that is coming to you, it can push you to a higher tax bracket. And maybe you will be paying way more taxes than even when you were in your best professional years. Yeah, because your money has been growing and growing in that tax-deferred account. And now the IRS is going to be dividing that money and telling you how much money you have to withdraw from that account. And the amounts can be really, really important there. So after we see this, why somebody would like to make and go for paying taxes today instead of just waiting for the RMDs? It's like, why should make that? So I think the right question to ask will be, if the taxes are the same for today and in the future, and they are not going to be moving or they're not going to go higher in the future, you can say that maybe it doesn't make a lot of sense, because you're going to be paying the same percentage of taxes today that the ones that are going to be paying in the future. But the thing here is, like, depending on the amount that you have to withdraw from your RMDs, maybe that is the thing that is going to push you to another tax bracket, and the percentage could be higher. Also, if you believe that we have a big deficit in the country and maybe in the future taxes could be higher, well, then we can say that if in that future taxes could be higher, then you will be paying more when you start making those withdrawals from your 401k or traditional IRA. And also sometimes people say, well, we don't know if taxes are going to be higher. I don't know if it's going to be in the same tax bracket. But sometimes when there are some couples, we do know that on average, one of them is going to be passing away before the other one. So there are going to be maybe some years that just one of you is going to be there. And when that happens, you're not going to be filing your taxes as a couple. You will be filing your taxes as an individual. And your deductions are going to be smaller, but your assets are going to be big now. So maybe you have to start withdrawing your RMDs on also your wife or husband and couple RMDs too. And that can even push you again to a higher tax bracket. So if we see it in that way, we can almost certainly say that if it's a couple, maybe in the future, taxes for one of them are going to be higher if one of them one of them pass away first. Okay. So really important information there. And let's keep looking about this one here. And how does this work? As we know, the US tax system is a progressive system. What does that mean? It means like, depending on how much money you're making, and remember, in this case, you can move that lever. You can decide how much money you would like to make. Yeah, and as you know, like the taxes are going to keep going higher in this way. If we see it like at the beginning, maybe you're in this 22% tax bracket, or maybe in this 24% tax bracket, you're filing as a couple and you're making between $96,000 and $206,000. But if you're starting making way more money, but if you're starting making more money from this amount, the extra income is going to come into this 24% tax bracket. Maybe it doesn't seem that bad. But if those RMDs are big enough, instead of 24, and you're making more than $394,000, the extra dollar is going to be here, and it's 32%, which is a big number there. So if we see that the thing that we try to do with a Roth conversion, you start like playing with those buckets. It's like, I don't know, you're here and you decided I'm making, I don't know, $100,000 and I don't want to go over this $206,000. So you start saying, okay, I'm going to make some Roth conversions for 100,000 more, because you don't want to be over that 206. That's part of what a Roth conversion strategy can help you to implement. So if we keep looking at like here, for those of you that, and this is not a political comment for those of you, I took this from a book. There is a really good book from by Ed Slott. The name of the book, the retirement saving time bump sticks louder. And he has like this really good material here. He was taking like the top federal income tax rate by years. And I was not aware of this one. If you see it, like if you see from here on all this for this great area from the 1946 till 1964, you can see that the maximum tax bracket was insane, was really, really high. You can almost see that it was close to 100% for many, many years. So after that, you can see that the top rate was 70% for many, many years. Maybe after 1982, it went down for that 50%. But it was not until 1987 that it went down, maybe, and for all these years. But when you see that now with the top rate is here at maybe, and this year in 2025, we are still in 37%. So we can see when we see this table here, I don't know, it was only in 1913 that taxes were like lower. But after that, on average, we can say that we are in the one of those here with the lowest tax bracket ever. So is this going to stay like that? Nobody knows. But is it lower than many years at the past? The short answer is yes. So it could make sense to pay taxes today at a lower rate than tomorrow at a higher rate. Yeah. So if we can look at it like here, we can see that there are a lot of changes with the new law. Your standard deduction here, this is like an example of what I was saying, that what I'm saying to you, like if taxes are going to be higher for you, this is the scenario about that couple. Maybe today you're getting like this standard deduction for 2025, like 31,500. If you're over 65, each one of you will get like this 1,600. And if you get this new deduction for your aging deduction, for each one of you is going to be $6,000 more. So you're going to be able to reduce as a couple like this $46,000 from your taxes. This same scenario, but let's say that one of them passed away and there's only one of them in the future. Or now if we run the same scenario in 2025, the standard deduction, instead of going for 31, will be 15. He's going to get that 1,600. He's going to get maybe that $6,000. By the way, this $6,000 start phasing out after you start making more than a certain number. I'm not going to bring that number here. But if we see it like, yeah, the amount of money that you are going to be able to reduce from your taxes is half of the amount of money that you will be reducing if you were a couple. So if you see that here, you will be paying taxes on those extra $23,000. And if we remember that bucket slide, maybe that's the thing that is going to push you to the next tax bracket there. So yeah, in a way, for those of you who ask, our taxes are going to be higher in the future? The short answer could be yeah, maybe they're going to be higher in the future, because if you just see it like that, we can see that scenario there. This is what we call the valley of tax optimization. What is that? As you can see, maybe you are here, you're working, both of you are working, your annual gross income is higher. Then one of you decide to stop working, and the other one of you also decide to stop working, and you retire. For a few years, you're not going to be receiving extra income, because like now, you're not receiving all those wages, all those bonus, and all those different things. So maybe your tax brackets could be here. But then after 73 or 75, the IRS is going to start telling you, you have to start withdrawing money. And as we can see it here, yeah, it will push you to a higher tax bracket there. So in a way, you can use these areas, I'm going to show you, to willingly go and pay those taxes, but for you to be able to reduce the balance in the future, so you don't have to withdraw as much money as you will have to. If we see that this one will be something like this, instead of going for this blue area, we can go for something like we can add those withdrawals from those accounts, pay those taxes for that extra income that you're getting. And maybe instead of having this big hill here, you're going to have maybe something like that, where your taxes are flatter. That money can be growing in a Roth account, and it can be growing in a free way for the future. So part of the job of a certified financial planner will be to help you to run these numbers, for you to know how much money you should be withdrawing from what accounts, what account you should be withdrawing first, and also what kind of investment should each kind of accounts have. But this is not as easy as it seems. The advisor is using really sophisticated software, because he has to also take into consideration, beside taxes, beside investments, also Medicare premiums, because we don't want those premiums to go higher. So there are a lot of things that are a lot of moving parts here. So your tax bracket, how much you're making for Medicare, the way their investments are made, and the balance of those RMDs in the future. And I will say that all of that comes is like how much money you're really needing if you need that money today, or if you're thinking about leaving a legacy, an inheritance, because you don't need that money right. So a lot of information here. If we see it, the goal of a financial planner doing something like this would be maybe your assets look like this one here today. Maybe you have some investment accounts that are taxable accounts. Maybe you have your 401ks, and maybe you have a small balance in your Roth or 401k or Roth IRA. With those Roth conversions, what you are trying to do is transferring some assets from these tax-deferred accounts into this Roth. And maybe you're trying to do something like this for these two areas. Yeah, trying to make it almost all tax-free. Because if that is your plan for the future, remember that if your beneficiaries inherit this money, the money that is coming from a tax-deferred account, they are going to have what is called the 10-year rule. And that means they're going to have 10 years to start withdrawing that money. Because for a while, think that, you are having such a great, nest egg there, and maybe you have, I don't know, $2 million there. But that will mean that for your beneficiaries, that I know they will be really happy for that. But in any way, you're adding $200,000 into their income, and that will push them to a higher tax bracket. Because if you don't, that is if you take $200,000 each year. If they don't do that and they just decided to wait for the 10 years and the money keep compounding and growing there, in the year number 10, they will have to withdraw all the balance, because the balance has to be depleted after that 10 year. So that will push them to the highest tax bracket, and they will be maybe losing a lot of money there. So we have been talking really well about the Roth conversions, but in what cases does not make sense? Well, of course, if your current, we discussed about it, if the tax brackets for today and for the future are going to be almost the same, makes no sense. If your current tax brackets are higher and you will be withdrawing more and more money, that will push it even to a higher tax bracket, so it makes no sense. When most of your assets are in a taxable account and your assets on the 401k or IRA are really small, it makes no sense a lot, because those Roth conversions are not going to be able to move your entire balance. Also, in a way, if I hope this will not be your case, it's like if you know that your life expectancy is really short. Because Roth conversions need two different kinds to be effective in the future. The first thing they need is time, and the second thing it needs is return. So if your time is really short, maybe you're not going to be having those RMDs in the future, or not for many, many years, or maybe, yes, yeah. Also, if you're needing that money, so you're going to be withdrawing that money now, you don't really care about the future in a way that you cannot be optimizing those taxes, because you really need that money for your day-to-day expenses. So you're not going to be there. So if you're not 65 years old yet, maybe you're 62, you decided to retire, and now you maybe are getting one of these health insurance from the Affordable Care Act. You're receiving a subsidy. And if you move your income higher, that will make you to lose that subsidy. And that subsidy is really, really important there. So, and also if you have a portfolio like in your 401k and your IRA, traditional IRA, you are really, aggressive in the way that you're investing. You have a lot of stocks there. The percentage of the stock was way higher than the percentage of bonds. And then you decided to transfer that money to do Roth conversion, that Kintsugi there. To that traditional IRA and Roth IRA, from the traditional IRA to the Roth IRA, but now you decide to invest that money in a really conservative way. You just leave that money in bonds, treasury, or something like that. And the speed that this new account has was not as fast as the one that you were having before. I'm talking about the return that you were maybe getting from that account. So these are the cases when maybe it doesn't make sense a lot to go for a Roth conversion there. So we have been discussing a lot of things. As you can see, there are a lot of moving parts here, and each case is completely different. This is why we run your particular scenario. And this is why we provide hourly financial planning for you, to check your case, to run all your numbers, and to tell you if it makes sense or not, and the different strategies that you should be implementing. If you want to ask for a free meeting, just go for our webpage or write us an email, and then we will be happy to serve you there. Well, thank you so much.